Hello everyone, and welcome to your final Glassnode video update for week 52. I'm your host Checkmate, and we're recording this on the 27th of December 2021. So as we close out the year, what we wanted to do is just provide a real overview of how the Bitcoin market has really performed. And we've seen prices up 78% since the start of the year. And nevertheless, it's been a tumultuous and volatile year. So we've seen a huge amount that's changed. From everything across both on-chain, on derivatives, exchange balances, and pretty much everything else you can imagine. And the mining market in particular actually is a very big one. So what we're really going to do is just do a bit of an overview. We're going to look at kind of all of the topics that we consider in these on-chain analysis videos. We'll keep it fairly high level and just kind of discuss the overall performance and really what has occurred over the course of 2021 and why, in review, it can kind of be described as almost a macro consolidation, a very big, high time frame consolidation where price is up, but generally most metrics have just changed just a little bit. So it's been a slight shift in balance between long-term holders and short-term holders. Exchange balances are kind of where they started. So not a great deal has changed from start to finish, but in between that, it's been a volatile and tumultuous ride. So let's get started and have a look at some of the details. So as I mentioned in the intro, Bitcoin opened the year at about $29,000, or $29,001 to be specific. Now we set a low of about $28,500, which is just slightly below that. But by and large, we essentially opened at the lows, traded back down to the lows in the middle of the year, and then have now got to the point where we haven't quite closed the year, but we're getting there, up around $51,000. So overall, about 78% price increase over the course of the year. And we're currently trading at around 24.4% below November's all-time high. So as you can see, it's been a pretty chaotic year. We've seen the ups, the downs, the swings sideways, but overall, if we look at this price pattern in general, it really is a very, very large macro sideways consolidation. So it kind of puts everything into context. We've still had a pretty good year, 78%. I'm not sure too many people would snuff at that. It's been a fairly strong year for Bitcoin as an asset. We've pushed up above the $1 trillion mark on 2 separate occasions now, and we've now fallen back below it and are getting ready, hopefully, to go pushing for that third attempt. Third time is the charm. So what is really important, and I just want to kind of set the scene here. I like to use these two metrics in combination. The first one is the UTXO realized price distribution and the percent supply and profit. So what is the URPD? The URPD metric looks at all of the coins in the coin supply, and it says what was the price or the bucket of the price where this last moved. So it's a little bit similar to a volume profile that you may see in technical analysis, where what we're looking for is where is there a clustering of overall coin volume? Where are we seeing lots of trading volume, lots of coins changing hands? And generally speaking, when you get these large clusters like we have here between 45,000 and our current price at 51,000, this is where we generally see a lot of accumulation that goes on or redistribution. So we talked about how we had a slightly top-heavy market over the last couple of weeks where a lot of the supply was redistributed up here in the 60,000s. Some of that is now being redistributed down to these lower levels. So to put this a little bit into context, we have around 19.5% of the total supply that was redistributed, or essentially the last time that it was spent, at a higher price. So some 20%, right? Not quite 20%, but just shy of, is sitting up here as an unrealized loss. So these are coin holders who are currently in the red. Some of them may well be thinking about selling because they've seen red for a certain period of time. There's only so much pain that people can take in financial markets. And some portion of these are going to be hodlers who really don't care what the price is. So we try to understand a little bit about the balance of these different cohorts. Generally, when we see a large pullback, we can see in this percent supply and profit from 100% by definition at all-time high, we declined down to around 71% of the total supply that was in profit. So we saw a fairly dramatic decline. About 29% of those coins came into an unrealized loss. And what we've now seen is a consolidation period over the last couple of weeks. So during that time, a bunch of coins have been accumulated down in this range. Somewhere around 11.5% of the total coin supply currently sits in this volume node. The next one below us is down around 40,000. So that's really where we found support back in September. That was the previous instance where we saw this play out. And what's quite important, particularly as we get a rally, and note that this is not a significant rally in terms of we're still really inside the trading range, but note that at around 51,000, we're at the top end of it. So because we're now at the top end of that trading range, all of the coins that were redistributed and found a new owner during that time are now going to be in profit. So we can actually see, it's almost a bit of a X-ray vision to see how many coins were distributed, found a new buyer, and therefore have a cost basis down in this zone. So it's kind of two different ways to observe this same phenomena. Here we can actually see the clustering of volume that sits at that particular point. And here we've seen a fairly dramatic increase of about 10.5% of the total supply. So that means that some 10.5% is sitting in this volume profile. Some of it may well have been accumulated back here or back here, but a good chunk of it is going to be sitting and has been recently redistributed. So generally speaking, that's telling us that at the very least, we have seen people come in and buy the dip. There has been accumulation down at this level. And really the question becomes, is that going to hold? Is there enough? Are they going to continue buying if price trades back down? These are all questions that we'll look to answer as we move into the new year. But most definitely what we've seen is a non-trivial amount of these coins get accumulated. And you can see previously where we get these very, very sharp rallies. Price doesn't have to move a great deal, but because it's putting that supply in profit, because a lot of it has been re-accumulated, we see these very sharp vertical rises in our percent supply and profit. So I'll be watching to see whether this metric in particular really starts to rise significantly as price, if it continues to push higher. Now, moving on to our cohorts. So we've got both of these charts. This is our long-term holder supply, short-term holder supply, and then comparing the two of them in terms of their profit and loss. So let's just start with the left-hand side first. Now I've got these charts set to year to date, so we can really see just the macro trend of what's gone on over the course of the year, and then more particularly what's going on in the current environment. Now note that long-term holders have increased from about 11.5 million coins up to, they hit 13.5, so that's over 2 million coins at the peak, and it's only slightly pulled back from there. Short-term holders, on the other hand, have seen a net decline of coins. They've seen about 1.5 million coins that have overall been distributed and transferred into that long-term holder status. So you can really see that there is a transition of wealth. Long-term holders added to their positions over the course of the year. Short-term holders reduced their positions over the course of the year. And overall, what we're seeing is this kind of macro consolidation. This generally describes, for want of a better term, a bear market or somewhat of a macro big picture consolidation. Generally speaking, we see long-term holders who actually start accumulating coins during those kind of periods where it's a little bit hairy. That's where short-term holders get a little bit spooked, they distribute their coins, and those with higher conviction step in, accumulate, and stick them into cold storage. Now that process can take some time, which is more or less what we've seen. 2021 has essentially been this macro sideways consolidation, albeit with some pretty dramatic declines and some pretty impressive rallies, right? And a number of all-time highs. So it's a bit funny in terms of what the actual market structure is. It does look a little bit like a bear, but simultaneously we've had phases which absolutely look like a bull market. So when you kind of combine all this together and we say, what did 2021 really look like? Overall, there was a long-term holder accumulation. We were seeing those smarter, higher conviction holders buying and sticking into cold storage. Fewer of those people who are stepping in purely for the speculation and the hype. We actually saw them generally bleeding out of the market. So most of that behavior typically looks like a consolidation or a bear market, which is quite interesting. Now, just in the immediate term, before we move on from this, note that long-term holders started their spending at the all-time high, which is very, very typical. We generally see this, and this is what bull markets actually look like. Let's zoom out to 2 years now, just in the long-term holder supply. This is what a bull market looks like when the long-term holders sell to new hands. So what you can see is we started to get that behavior, but it's more or less been arrested and actually started to reverse. So our long-term holders have actually returned to a very slight level of accumulation. And the short-term holders is the exact opposite. On a 2-year basis, they acquire new coins that are distributed in a bull. So a bull market is where their supply goes higher. They generally leave the market and the long-term holders step in and accumulate during the bear. And we can see that we almost got a return to a bull, but it's also slowing down. So it's a very, very interesting dynamic. It very much looks like a big picture consolidation. Overall, if we look at this in terms of the relative supply that they own, long-term holders have essentially added about 4.8% over the course of the year in terms of their total dominance. So if we look at all of the coins, I call it sovereign supply, the supply that's outside of exchanges, we use that as our denominator to derive this metric. It's essentially looking at, for all the long-term holders, how much of the coin supply do they own and how much is in profit and loss. So over the course of 2021, they've added 4.8% of that sovereign supply, all of the coins that exist outside of the exchange balance. And that naturally means that the short-term holders have declined by an equivalent amount in that dominance. Now, on the exchange front, and we've got both our spot exchanges up here. This is our kind of on-chain flows in and out. And we've also got our derivatives market. So we'll touch on these one by one. Now, in terms of the overall balance on exchanges, so on a macro scale, we've still got this big picture downtrend in play. But note how 2021 was marked by periods of outflows, a big period of inflow during the May through to July period. Then we reverted back down into an outflow, and then we've more or less traded sideways ever since around September. So if we actually look at this overall, the actual net outflow of exchanges has been only 67,000 coins, which is only around 2.5% of the exchange balance has actually declined, which is quite remarkable. So on a percent of balance exchanges, because remember, new coins are coming into the supply all the time, and not all of those made it onto an exchange for sale. But so on a net percent of supply, we have seen this downtrend. But on an absolute value, when we look at all of the actual coins, what was the starting balance? About 2.6 million. What was the ending balance? It was about 68,000 coins less than where we started. So on a macro scale, 2.5% decline, it's actually kind of sideways, which is a very interesting dynamic. So overall, the number of coins that flowing into the exchange was only just offset by the amount of coins flowing out of the exchange, which is quite interesting. And really, we saw a lot of those coins get sucked out of the exchange in the early part of the year. This was when the grayscale arbitrage was in play. We saw a lot of them flow back in after the Elon tweet, where we started to get all of the energy FUD. And, it was a pretty grim time through May into July. And then we've more or less seen that trend reverse back to the downside. So it's going to be very interesting to see where this goes into 2022, whether we continue to see these exchange outflows. Do we continue to get it trading sideways? This will be something that we're watching, because it obviously creates a balance of, are there more coins or less coins, and general sentiment. Are people willing to exit? Do they want to leave their position and sell their coins? Or are they actually buying and sticking it into cold storage, which is more or less the trend that we've seen over the last year or two. Now, on the derivative side of the equation, we actually have a very different story. So let's look at this on a year-to-date basis, and we'll do our volume as well. So in terms of our total open interest, remember, this is the number of open contracts. There's a couple of questions in the comments the other day asking how much of these are long and short. With futures, they are by definition 50-50. So there's for every opening of a short, there's an opening of a long, and vice versa. So what happens is with these futures contracts, there's two different types. There's the perpetual futures, which means that they never expire, and they use the funding rate to keep things in balance and track the spot price. And the other ones are actually expiring contracts. So they may be for December at the end of the year. People are essentially betting on what the price will be at the end of that year. Miners can use those futures contracts to hedge out their risk. So can investors and traders and the like. So there's parties on both sides. But what we're generally seeing is that the overall open interest, or the number of open contracts, has essentially doubled, about 97%. So more or less doubled since the start of the year. So from just under 10 billion to around 20 billion at the moment. So we've seen a fairly substantial, a non-trivial rise in futures, right? And when you compare that to our exchange balances, where we're kind of on net in terms of spot holdings, what we've essentially seen is a massive rise, a doubling of futures, and the trading volume really speaks to that as well. Futures volume tends to be quite a bit larger than our spot trading volume. Now, what is quite interesting, and again speaks to this macro consolidation concept we've been talking about, is that overall, you can see this kind of big descending pattern that we have in futures volume, right? So overall, we have in fact seen a decline, and note particularly through December. This is very common. We see a real slowdown in trading. This is not just in Bitcoin and crypto markets. We see this across traditional markets as well. As the world heads into holiday season, there's fewer people sitting at their desks trading. So we do see a decline in volume. But on a 7-day moving average basis, if we look at where we started and where we currently are, it's amazing that the volume is actually down around 16%. Again, bearing in mind that this kind of takes into account this slowdown in December. But if we map it to just kind of these lows, right? Let's take these low points which seem to be relatively consistent, they're all sitting around $40–50 billion in daily trading volume. So really the volume hasn't increased over the course of the year. We've obviously had periods where it's been much higher, particularly during high volatility and the like. But if we look at it on an overall long-term average, it's actually sitting roughly where we started. So open interest is higher by about 2x, but the trading volume is actually roughly the same, or even a little bit down, which is quite interesting. It's really showing that we're starting to get, there is a risk involved there, and particularly when we note that there's a rise in the last couple of days in terms of this open interest, about 2.5 billion. A lot of this is in Binance, which is on this this pink chart down the bottom here. So we have seen over the last couple of weeks rising open interest on declining volume. Can set a little bit of a stage for maybe there's a long or a short squeeze that can happen, because you've got thinner order books plus people that need to be force exited in either direction. And when you get a rising of open interest, it means that more people probably have a stop loss or some kind of liquidation level closer to price. So there is that risk there. But overall, when we see this declining trading volume, that's a very typical pattern in technical markets, which is generally describing a macro consolidation. It's showing less interest in trading as the market kind of squeezes into some kind of eventual result, but the market is essentially trading sideways on the big picture. So this is just kind of more evidence pointing to we're probably in this big picture consolidation phase. We don't know when we're going to kind of get to the end of that phase, when we start to get some real volatility outside of this trading range. But generally, when these big picture consolidations happen, the move that comes after is generally commensurate with the length. So we saw this in the 2018 through 2020 bear market. Essentially, the price rally that we saw over the last 2 years was the result of that. We saw this big multi-year consolidation, and then that broke out into a very, very significant rally. We went from 10,000 up to 64,000 over the span of a couple of months. So this is typically how markets work. So it's just something that we're paying attention to and we'll observe as we move into 2022. Now, the last one I want to close on, this is actually my favorite set of charts for this week. We're looking at the mining market. Now, we saw an incredible event occur this year. In May, we essentially saw some 53% of the entire mining market, and the way that we measure that is from the peak to the trough on a 7-day moving average, so it takes out the daily noise. But really what we're looking at here is the hash rate. Some 53% of it was almost taken off overnight over the span of about a month or two. And this was due to a complete reshuffling of the mining industry. Miners in China were essentially forced to shut down their operations, to either relocate or sell their hardware. They were no longer allowed to operate in the Chinese jurisdiction. And we've essentially seen more than half of the mining industry have to be rehomed. Now, what is just so incredible about this is that through this period of time, the difficulty adjustment wound down, block times adjusted, and we've essentially seen the protocol continue to produce blocks. So they were slower initially, the difficulty adjusts down, then it starts to catch back on, miners start to come back online as new machines are rehomed around the world, they find new power sources and new operators, and what we've seen is this incredible complete recovery over the course of 2021 to actually close out at a brand new all-time high of hash rate of 182 exahash. So the Bitcoin network has essentially regrown itself. We've seen the mining market completely recover. The financial incentives were there to move all of the hardware, to make the logistics work. And that's what we have on the right-hand side here is the total miner revenue. So this includes the fees and the block subsidy priced in US dollars. And really, this is the driving force behind how the mining market can undergo such an incredible industrial shift and essentially just regenerate and recover over the span of the back half of the year. So what we've seen, here's our halving back here in May 2020. So the overall mining revenue, so this is all miners. How much is Bitcoin paying per day to all of the miners on the network? It's obviously divvied up by how much hash rate each one has. But what we had after the halving is about $8.5 million, thereabouts, that was being paid out per day. Now, what we've essentially traded up to is that at the start of the year was about $29 million a day, and where we currently are is closer to $46 million a day. So we're actually, since the halving, after the block reward was halved from 12.5 to 6.25, we're currently sitting about 440% higher in terms of total miner revenue, which again is creating that incentive for miners to come online, to deal with the logistical challenges, to cross language barriers, to move hardware around the world, and essentially to bring Bitcoin completely back to where it was prior to the, and hit new all-time highs in hash rate, fully regenerate the industry. And this is what is driving it, is this mining revenue incentive, this free market incentive that, creates this fascinating industry that Bitcoin has created. So thank you all for tuning in. It's been a really, really fantastic year. Hope you all enjoyed these videos. We're certainly looking forward to our team producing more of them into 2022. So stay tuned for that and for more Week on Chain newsletters and some more big things coming in 2022. Wish you all a very happy holidays, and I'll see you next week. Cheers.